All right, so let's take a look at an exercise. I have a lot to do here. We're looking at computing return on assets, profit margin, and asset turnover. And let's see here. Let's put a period right here. Let's refer to the financial information for target corporation using the balance sheet, which we have here, and the income statement, which we have right here. Okay, so we're going to need both of these items, and then if we scroll down here a little bit, so try to fit all this on one page. We will have to move the page up and down a little bit. Okay, so lots of numbers, but which number do we actually need? Well, let's find out. Requirement A for the exercise says compute its company's return on assets for the fiscal year ending February the 3rd, 2018. And they want us to compute two measures, one using net earnings from continuing operations, and then one using simply net earnings. Okay, so it looks like what I'm seeing, there's not going to be much of a difference in these figures. Return on assets is a ratio. It is presented as a percentage. So anytime we look to do something like this, we have to account for several things. And so what they're wanting from us here the first thing is they want us to calculate ROA for using net earnings from continuing operations. Okay, so that's going to be a little bit different. If we look, so to get earnings, we know that we need to look at the income statement. And we have right here net earnings from continuing operations. We've tallied it up here. And we have 2928. So let's go ahead and put that down. 2928. However, if we look up here, we also notice that we have a interest expense item here. And so interest expense, would be in the third part of an income statement. It would be into the other income and expense, gains and losses section. So what we're going to actually do is we're going to start with 2928, but we're going to add this $666 interest expense back part of the way. Now, why do I say part of the way? Well, because, now let's see, not 660, it was 666. And so we have to add that back in at its net value. And what we're talking about here is, it says assume an income tax rate of 25%. So what I'm going to do is I'm going to say, okay, well, if the income tax rate is 25%, then I can just multiply by 0.75. All right. So this is a type of an adjustment that we would do. If we're talking about net earnings from continuing operations, if we think about an income statement, we've got our revenue and any cost of goods sold items up at the top. Then we have our operating expenses, and then everything after that is not from operations. So that's why we're going to start with our 2928. We're going to add expense essentially at its net value, adjusting for income tax. So let's see what that is. Okay, $499.50. So let's do this. Let's do $29.28 plus $499.50. So now I'm just going to add the $29.28 to that since it's already on the calculator. And that gives me $3,427.50. However, to get ROA, I have to move over onto the balance sheet. Okay, so because I'm saying, okay, this is what I got. What was my level of assets? And so we go up here, and we see that assets as of February the 3rd. Let's see, maybe move that down a little bit. Were $38,999. However, this is at the end of the fiscal year. So we have to take both of these figures and get an average between them. Okay, so I'm going to move the paper back down. And my first figure was $38,999 plus $37,431, and I'm going to divide that by 2 to get the average. So I'll go ahead and do that. Let's see here, it was $37,431. And then I'm going to divide, I need to divide that number by 2. So this 38,000 here, 38,215 is average assets. Okay. And so what I'm going to do now is I'm simply going to take this 3427.5 and I'm going to divide it by average assets of 38,215, and let's see what that gives us. Looks like it's going to give us 8.97% if we round this. Okay, equals an ROA of 8.97%. All right. So the second part of this, we'll kind of probably have to do this over here to the side, but that's okay. So this is our first answer. So we'll put a little box around it. The second part of this says one using net earnings. So net earnings is right here. So now these figures are stated in millions, but we had discontinued operations net of tax gain for $6 million, or for our purposes $6. And so our net earnings were actually $29.34. So basically we're going to do the exact same thing that we did before, but instead of starting with $29.28, we're going to use $29.34 instead. Okay. So if that's true, all we really have to do is the same thing that we already did, but just change this number to $29.34. So I'm going to kind of do that right over here to the side. $29.34, and then I'm going to add to that the same, let's see, where'd it go, $499.50. Okay, because this part of the equation won't change. I still have to add back in the net interest expense at its net value after the tax benefit. So that's going to be $499.50. And so basically, you know, we came up with $34.27.50 here. All we really have to do is just add $6 to that, or in our case, $6 million. Okay. Then we can just divide by the same average assets that we already used, 38,215. So let's bring our calculator over here and do just that. So 3433 divided by 38,215 is going to give us 8.98%. So let me minimize this calculator real quick. Notice that there's almost no difference in our answers here for the parts. So this was part 1, and we'll put part 2 here to kind of label them. And the reason is because this figure was so small. If it had been a much larger figure, well then we could have seen some different. In this particular case, we really did not see anything. So it says for requirement B, disaggregate return on assets into profit margin and asset turnover. And so if we do that, then confirm that return on assets equals profit margin times asset turnover ratio. Okay, so basically what we're doing here is we're, when they say disaggregate, all we're really talking about is we are removing items from the equation, so to speak. And so we've actually already done some of this whenever we remove the interest expense. Okay, so what we're going to do is we're going to use the figure based on continuing operations, which we've already calculated as 3427.50. And what we're trying to get right here is our profit margin. So we've got that, and then we're going to divide by our sales revenue, 71,879. And this, when we do this, this will give us our profit margin. So let me get the calculator over here. 3427.5 divided by 71,879. Okay, and that's going to give us, let's see here, 4.77%. They wanted us to round to 2 decimal places. 4.77%, and that is our profit margin. And then we also have to calculate our asset turnover ratio. And so the formula for asset turnover ratio is revenues. So asset turnover is revenues divided by average assets. Okay, so I didn't write the formula for profit margin because we're using a specific form of our income or our earnings, and so the definition won't always apply. But for asset turnover ratio, we're going to take revenues divided by average assets. Well, we know that our revenues are 71,879. Okay, and then we're going to divide that by the average assets that we already calculated, 38,215. Okay, so let's do that. 71,879 divided by 38,215 average assets. And let's see here, 1.88. 1.88. Okay, So this is our asset turnover ratio. And then we're going to actually multiply our asset turnover ratio. So ROA then can be calculated, at least here, as profit margin times asset turnover. So we're going to take asset turnover of 1.88 times 4.77%, which is our profit margin, and we're going to find out what we come up with. Let's see here. 1.88 asset turnover times 4.77 gives us 8.97%. So you may wonder, interesting, these two numbers are the exact same. Well, that's because we actually did the exact same thing. We calculated return on assets. We just went about it in a couple of different ways. And keep in mind, we did this figure down here. The only thing that changed was that we used profit margin as part of our formula. All right, that's it for this video.